IIE Financial's educational series, Basic Options for Investors. At IIE Financial, we believe in willing the good of another, and oftentimes options can be an excellent asset for investors to look at in their portfolios. We put this series together because investors are oftentimes not truly educated on how options work and whether or not they should use them in their portfolios. Now, certainly options are not suitable for every investor, and you should visit www.optionseducation.org for full details so that you understand the risks and characteristics of standardized options. But as we go through this session, the purpose of it is to see whether or not it makes sense for you as an investor to utilize options in your portfolio. So let's talk about some of the basics of what options are and what we use them for. So options are essentially financial instruments that allow the buyer to control a security for a given period of time without owning the underlying security for a fraction the cost of owning the security. So what we're essentially speaking about is control versus ownership. Now, we're going to start with the definition of our two types of options before we really dive in and investigate how they work. So there are only two types of options that an investor can utilize in their portfolio. And to make it fairly simple, the two option types are calls and puts. Now, those two option types, calls and puts, have only two actions that can be taken by an investor. You can be the buyer of an option, or you can be the seller of an option. So really, if you think about it, there's two actions that the investor can take and two types of options, so the outcome really leaves four different descriptions. So the buyer of a call option has the right, but not the obligation to buy a set stock at a set price on or before a set date in exchange for a premium paid. Now, we're going to break down that definition a little bit deeper later on, but one of the things I want you to notice is that a call option gives somebody a right. When they buy it, they have a right. Now, it's also in exchange for a premium paid, meaning money is coming out of the investor's pocket in order to finance the purchase of the call option. Now, the put is the right, but not the obligation to sell a set stock at a set price on or before a set date in exchange for a premium paid. Now, once again, notice that the put offers a right. Notice again that the put is in exchange for a premium paid. So what's the difference? Well, really, it's a one-word difference between calls and puts. A call gives someone the right to buy a set stock, whereas a put gives someone the right to sell a set stock. So let's look at the seller of an option. As the seller of an option, there is an obligation to sell a set stock at a set price on or before a set date in exchange for a premium received. Notice the difference between the buyer and the seller. The seller actually takes on an obligation to provide stock in exchange for a premium received, meaning that the seller of the call gets paid in exchange for taking on an obligation. And the seller of a put also takes on the obligation. However, the put has the obligation to buy a set stock at a set price on or before a set date in exchange for a premium received. Once again, the only difference between calls and puts is the buying and the selling. So what does all this mean for an investor? And that's a lot of words, but let's break it down to what it means for an investor. So as an investor, what this means is that a call option will increase in value as the underlying security goes up if somebody bought the call option. A put option will increase in value as the underlying security goes down. So notice that both of them will increase in value, but for a call option, it's going to increase in value as the underlying security goes up. A put option will increase in value as the underlying security goes down. Now, as the seller of an option, it's going to be exactly the opposite. As the seller of an option, the call will decrease in value. The call will decrease in value if the underlying rises, but it will increase in value if the underlying goes down. So if you were the seller of a call, you would want the security to go down. If you're the seller of a put, you might want the security to rise. So notice that buy and sell are opposite of one another, and calls and puts are opposite. So let's take a look at some examples that hopefully will help to make this a little bit more apparent and a little bit easier to understand. So let's start with something very simple. And we like to use real estate as an example because it's tangible. It's something we can hold in our hands. It's something that people see on a regular basis. So here is an example of a home that is for sale. Now this beautiful brick home is for sale for $300,000 US. It has a for sale sign in the front yard. Let's say that our investor Jim wants to buy the home. Just not yet. Jim needs to make sure that he can find work in the area. So instead of buying the home, what he's going to do is he's going to buy an option on the home. So Jim might go to the homeowner and ask the homeowner if he can purchase the home anytime in the next 3 months. Now, the homeowner is certainly going to want to sell the home as quickly as possible, but the homeowner may agree to this deal and sell the option for a price of $5,000. So now they will write a contract, and that contract will have an expiration date. Now, that expiration date is 3 months from today, and they will strike a deal, and the deal that they'll strike is to purchase the house for $300,000. Now, Jim is going to give that homeowner $5,000 for the option. This is not a down payment on the home. So if Jim decides to buy the home, his total purchase price will be $305,000. So let's look at what happens with that particular home. Now, while Jim has that home under contract, he is the controller of that home. Oil is discovered. Well, all of a sudden, that home, which was worth $300,000, is now worth $500,000. So Jim's contract to buy the house has increased in value. As the underlying security has gone up, so too has Jim's contract. What about if it went the other way? What if underneath Jim's house they discovered nuclear waste? Well, that $300,000 home, it's now only worth $50,000. So Jim's contract to buy the house at $300,000 has decreased in value, but he can only lose what he paid for the option. So take it from the house to an actual security. So take a look at XYZ Corporation. XYZ Corporation, let's say that we have a stock certificate of 100 shares, and it's currently trading for $50 a share. So an investor might have a bullish outlook on the stock and believes that the stock will rise to 60 in the next 3 months. Since the investor believes that the stock will rise, he may want to profit from the rise in the stock, but does not want to pay the full cost of ownership. Instead, he would like to control the stock for that 3-month period. So maybe the investor buys a May of 2019 call option. Now, this gives the investor the right, but not the obligation, to purchase the stock at $50 a share between now and May of 2019, no matter how high the stock goes. Theoretically, let's say that this option costs $8 per share. So now the investor has the right, but not the obligation, to buy the stock at $50 a share, but instead of spending $50 a share, he's only paying $8 a share. Now, over the course of the next 3 months, that option is going to change in value, but that $8 a share is the option's price. It's known as the premium. Now, the premium is made up of 2 important components: intrinsic value plus the extrinsic value. So let's define what those mean. So the intrinsic value, it's what the option is worth relative to the price of the stock. So if a stock is trading at $52 and you own the $50 call, then the option has $2 of value built in, hence the word intrinsic. Remember that the $50 call means you have the right to buy the stock at 50 no matter how high it goes. Well, if the stock is trading at 52, you have that $2 of intrinsic value. Extrinsic value is the time and volatility component of the option's price. And what that means is when we purchase an option, we're essentially purchasing time. And the time is how long we anticipate staying in the position. In our example of XYZ Security, we planned on being in the position for 3 months. That 3 months was the time value. Now, the volatility component is a little bit more complicated than we want to dive into in this presentation, but volatility is the expected movement assigned to the security by the option specialists. And the volatility is really going to be based upon how much they think the stock is going to move over the course of, say, the next year. So when I look at our ABC company, if we expect the movement in 3 months, the stock can be trading high, low, or relatively the same. So let's see what happens if the stock goes up to 60. Well, if the stock goes up to 60, the option will now have $10 of intrinsic value, meaning that we have the right to buy it for 50, but the stock is now worth 60, so there is $10 of intrinsic value. Now, when we first bought the option, it was an $8 cost. Some time has decayed since this point, so we've lost some time value, so maybe our time value has $6 of extrinsic value. So what the investor bought for 8 could now sell for 16. Well, what if the stock stays at 50? Well, if the stock stays at 50, then you're going to have $0 of intrinsic value. In this case, the security will have lost some time, and so the extrinsic value will have dropped. So what the investor bought for 8, he may now sell for 6. What if the stock drops in value? Well, if the stock drops in value to 40, the option has $0 of intrinsic value, but you're certainly going to lose more of the extrinsic value if it goes against you. So what the investor bought for 8, he may have to sell for 4. So what we can see here is that with the call option, we have the ability to make a significantly higher percentage when we are correct on direction, but we certainly could lose a bigger percentage when we're incorrect on direction. So it's very important when doing this that we understand that we have an idea of where we believe the stock will go in a given period of time. So as an investor, how can we utilize these? Well, there's a couple ways to use options as an investor. The first is simply as a stock substitute, buying call options as a substitute for buying stock. We can use them as stock protection, using them as an insurance policy to protect against stock that is owned. A third way is to buy stock at a discount. And when we buy stock at a discount, we're selling puts as a way to acquire stock at the price the investor wants. And then there's collecting extra income by being willing to sell stock. Selling call options as a way to sell stock at a price the investor is willing to sell and bringing in extra income. Today, let's talk about utilizing stock substitute, buying call options as a substitute for buying stock, and buying put options as a substitute for shorting stock. The easiest way to remember this is to think about a telephone. Now, many of us don't have a telephone like this anymore, but the way I was first taught, and a great way to remember it, is we call up to order a pizza, and we're done, we put the phone down. Calls make money when the underlying stock goes up. Puts make money when the underlying stock goes down. Call up, put down. So if we think that a stock is going up, we would buy a call. If we think that a stock is going down, we would buy a put. So let's look at an example. Here's an example of ExxonMobil. And this is an investor wanting to participate in a possible short-term upside move in ExxonMobil, but he does not want to buy the shares. Now, on this particular day, and this is right from Yahoo Finance, ExxonMobil was trading for $76.67 per share. So looking at the call option, the investor may choose to buy the November 2017 75 call option. Now that seems like a lot, but don't let it overly confuse you. The green box we put there, if you notice, it has a column for a bid and a column for an ask. The bid is the price you will receive if you are selling the stock. The ask is the price you will receive if you are buying the stock. A great way to remember it is you're always going to get the one you don't want. So when buying the stock, you're going to buy the higher price. So the premium for this option is $3.40 a share. So this allows the investor to control ExxonMobil until November of 2017 for $3.40 a share, instead of owning the stock for $76.67 a share. Now, this allows an investor to participate in the movement of ExxonMobil, because if ExxonMobil goes up in value, so too will the value of the call option. So this allows the investor to be part of the movement and still benefit from the movement. So here's an example. Boeing Airlines. Here's an example from May of 2017, where it was trading for $183.04. Now, it was trading for $183.04 on May the 15th. And if the investor had a price target of $200 per share, he could buy the call option instead of purchasing the shares. Now, looking at what is down below, known as the options chain, the investor can buy the call options for $9 a share plus commissions. This gives the investor the right, but not the obligation, between the date of May 15th and September to purchase the stock at $180 no matter how high the stock goes. Now, over the course of the next few months, Boeing reaches the price target. And it actually reached the price target on June the 20th. So on June the 20th, Boeing reached the price target and was trading at $200.09 a share. So the investor at that point may elect to sell the options. Now, those options that he purchased for $9 a share are now selling for $21.65 a share. So let's look at what the results would be. In purchasing the stock itself, as an investor that purchased 100 shares, assuming $4.95, which is a fairly standard commissionable amount, versus one options contract. Now remember, options are traded in contracts. Each options contract controls 100 shares of stock. So we're going to compare these apples to apples, if you will. Now, when we buy 100 shares of stock on 5/15 at $183 a share plus commissions, our total proceeds required in that position are $18,308.95. If I buy one options contract at $9 a share plus commissions, my total proceeds required are $905.60 a share. So I can actually be part of the equity market by utilizing a derivative, the option, for a fraction of the cost. Now, when the stock on June the 20th is trading for $200.09, the investor can sell the stock and he's going to receive $20,004.05 in proceeds. On the same date, if the investor elects to sell the options, he's going to sell it for $21.65 minus commissions for a total of $2,159.40. So the proceeds from the sale after commissions on the stock are $1,695. whereas on the option, it's $1,253. So certainly the investor brings in more capital by investing in stock. But when we look at the rate of return, the stock provided a 9.25% rate of return in that given month. That's an excellent return, and a return that any investor, I'm sure, would be happy to receive. But the option on the exact same movement returned 138.4%. This leverage is one of the amazing benefits of options. Now, certainly had it went the other way, the percentage on the downside is also increased. Remember that leverage cuts both ways. So one of the important things to remember about this call option example is that the underlying security must have a directional bias. And that directional bias is an important part of identifying what we're going to do. So if the stock drops the wrong directions, they will both lose value. But there are differences in what and how they will lose value. In the stock purchase, the full value of the purchase is technically at risk. Now, the investor could receive dividends to offset some of those losses, and the advantage of the stock is that the investor can hold the stock indefinitely and hope for price to rebound until the stock either declares bankruptcy, goes out of business, or falls to a point where the investor is no longer comfortable holding it. The investor can indefinitely hold on to that security. Now, the options contract, the risk is certainly the full value of the options purchase, but the options purchase is significantly smaller than the stock purchase. Now, the difference also is that the investor cannot hold the option indefinitely and hope for a rebound. The movement has to occur in a given period of time, and the investor is not going to get paid dividends that go to the shareholders. So we have to understand the positives and negatives of both sides. And the key here is that the investor had a target and a belief that the stock was going to move to a given point. So call options are used when we believe that the underlying security is going to rise. Let's take a look at an example of a put option. Now here's a picture of Starbucks on June 22nd, trading at $59.69. If the investor has a price target of $55 a share, he could buy a put option instead of shorting the shares. Many investors would like to be able to profit from down market movements. A put option allows an investor the ability to do that. So the September 62.50 put option is going to cost the investor $3.75 a share plus commissions. Now, a few weeks later, on July the 28th, Starbucks has reached its price target. An earnings report has come out, and the price of Starbucks has dropped to $54.76 per share. So this investor may now elect to sell the options that were purchased. And he can sell those 62.50 put options for $8.15 a share. So once again, comparing the two, apples to apples, shorting the stock or buying a put option. When shorting the stock, we'll assume $4.95 for commissions. When buying the put option, we'll assume $5.60 for commissions. Now, one thing we did not take into account in shorting the stock is the additional cost of margin when shorting the stock. The additional cost of margin when shorting the stock has not been calculated, but that would certainly reduce the return on the shorting of the stock. So when shorting the stock, we short 100 shares at $6.22 for $59.69. So the total proceeds required are $5,973.95. Instead, we could buy one contract. Now that's going to cost us $3.75 a share plus commissions for a total proceeds of $380. On July 28th, buying back the shares that were shorted for $54.76 is going to bring in $54.7105. On the put option, we're selling the contract for $8.15. So we bought it for $3.75 and we're selling it for $8.15. Total proceeds $8.09. So when we look at the profit on both, in the shorting of the stock, it's going to bring in $502.90 of profit. That's an 8.41% rate of return. Once again, a rate of return that almost any investor would be happy to receive. The put option still brings in $428 per the contract, which is a rate of return of 112.66%, a significantly higher rate of return than simply shorting the stock. What happens if we're wrong? If we're wrong and the stock rises in value. So we only would be wrong if it rises in value, and both positions will lose money, but there's some differences. First of all, when shorting the stock, technically there is unlimited risk when shorting stock. This is why shorting stock cannot be done in an IRA. Retirement accounts are not allowed to short stock, and the investor could be required to pay the dividends that come out from the stock. Now, the investor can hold the stock indefinitely and hope for it to rebound in its direction, meaning that the stock can fall, whereas when the put option, the full purchase value is at risk. So the unlimited risk element goes away. This means that put options can be done in retirement accounts. The investor cannot hold the option indefinitely and hope for that drop, but the investor will also not be forced to distribute dividends that are paid to the shareholders. So when looking at a put option, there are many reasons why an investor might choose to utilize a put option in order to benefit from a down market. Options may be an option for an investor to speculate on the price of a security and control the stock for a fraction of the cost of ownership. Some of the benefits are the fractional use of capital to speculate on direction. It allows somebody to actually speculate on the direction without taking as large of a position, thus reducing the overall exposure. Another advantage of these options is that they can be used in an individual retirement account. Now, you need to speak to your financial advisor to really find out the details of your plan, but this is often something that is overlooked by investors that are looking to profit from direction. Now, if the direction is correct, the ROI will typically be higher than owning the security, and it can be used to play both up and down markets. Now, the cons are that the movement must happen in a given period of time, or the investor will lose value. The investor also has no ownership, so they receive no dividends or voting rights, and these can have a slightly higher commission than stock trading. If the direction is incorrect, the loss as a percentage of investment will be magnified. Hopefully, you're able to see a little bit of the benefits of options in your portfolio. And at IIE Financial, one of the things that we do is we help our clients to see some of the values of options in their portfolios. If you'd like to learn more about how options can be utilized in your portfolio and to see if IIE Financial can help you to design a plan that fits your specific needs, call our offices today at 832-953-4998 or visit us online at iiefinancial.com. Thanks so much. Please subscribe to our channel if you like our videos and you want to learn a little bit more. Have an excellent day.